10 Best ETFs for Investors to Buy in 2024. Welcome to Simple Investing Secrets, your trusted source for valuable investment insights, stock recommendations, and strategies to help you achieve financial freedom. In today's video, we'll delve into the 10 best ETFs for investors to buy in 2024. So before we start, we kindly ask that you like this video and subscribe to our channel for weekly updates. Let's get started. As the possibility of a recession looms, astute investors are turning their attention to stable and yield-friendly value stocks. Exchange-traded funds, ETFs, are an easy entry point into investing. They provide quick, broad exposure to the financial markets. Even better, ETFs are far easier to manage than a diversified portfolio of individual assets. If ETF investing is on your list of New Year's resolutions, you're in the right place. In this video, you'll find an introduction to the benefits of ETFs, plus 10 top funds to research and tips on using them to get wealthier in 2024 and beyond. The appeal of ETFs. Investors in the United States now have access to 46% more ETFs than they did 3 years ago. The growth is demand-driven. Apparently, investors love ETFs. Given that ETFs provide instant diversification, simple portfolio management, a plethora of options at low fees, and superior liquidity and pricing transparency over mutual funds, this is hardly surprising. Diversification. To diversify a stock portfolio sufficiently, you'd need to own 20 or more individual stocks. On the other hand, you could gain exposure to hundreds or thousands of positions in a single ETF. You can also find ETFs that fulfill nearly any investing strategy, from full market plays to niche assets. Some ETFs even maintain asset allocation portfolios that are designed to be the only position you own. Portfolio management. You must devote time to research, monitoring, and rebalancing for each position you own. Investing in a portfolio of 5 ETFs instead of 20 individual stocks will require a far smaller total time commitment from you. Low-fee options. One disadvantage of ETF investing over direct stock purchases is fees. Fortunately, there are lots of options for low-cost funds. For instance, simple index funds may have expense ratios that are almost nil. Expenses will be slightly higher for funds that use specialized strategies, frequently rebalance, and have international exposure. Liquidity and price transparency. ETFs trade throughout the day like stocks, while mutual funds settle and reprice once daily. When you buy or sell a mutual fund, you don't know the transaction price until after the stock market closes. This unknown won't make or break your long-term investment performance, but it can be disconcerting. With that said, let's look at our list of the 10 best ETFs for investors to buy in 2024. Number 1. SPDR Portfolio S&P 500 ETF. The expense ratio is 0.02%. The dividend yield is 1.4%. SPLG tracks the S&P 500, a large-cap index that includes 500 of the most established and successful stocks in the U.S. To be included in the index, companies must meet profitability, capitalization, and share liquidity requirements. Like all index funds, SPLG seeks to produce returns that mirror its underlying index before fees and expenses. It's tough not to include an S&P 500 fund in this list. The index, which includes the largest and most successful public companies in the U.S., has produced double-digit average returns before taxes over the long term. SPLG gets the nod as one of my best ETFs for its low expense ratio and high trading volume. Number 2. Invesco S&P 500 Equal Weight ETF. Expense ratio is 0.20%. Dividend yield is 1.8%. RSP tracks an index comprised of S&P 500 stocks in equal weights. The standard S&P 500 index weights holdings by market capitalization. In that structure, bigger companies like Apple and Microsoft have greater influence over the index as a whole. RSP is a top pick because it's the largest equal weight S&P 500 fund, and it has a tidy expense ratio of 0.20%. Note that expense ratios for equal weight funds can be higher than those of cap-weighted funds. This is mainly an outcome of the extra rebalancing required to keep the targeted allocation. While no one's complaining about the S&P 500's market cap-weighted performance this year, there are good arguments for an equal-weighted fund like RSP. Equal weighting provides more balanced diversification and has the potential for better returns. For one, it allows growth in smaller stocks to be more influential. And the regular fund rebalancing incorporates profit-taking to reinvest in stocks with more room to grow. Number 3. Schwab U.S. Dividend ETF. Expense ratio is 0.06%. Dividend yield is 3.7%. SCHD tracks the performance of the Dow Jones U.S. Dividend 100 Index. The index includes blue-chip stocks that pay consistent and competitive dividends. SCHD is a solid choice among dividend ETFs. The fund invests in financially stable companies with long histories of dividend payments. The yield of 3.7% is impressive, especially given the quality of the holdings. Additionally, SCHD has consistently produced appreciation returns alongside the dividend yield. Splitting returns across growth and income is more tax efficient than, say, a bond portfolio that solely produces income. Number 4. NASDAQ 100 Equal Weighted Index Shares. Expense ratio is 0.35%. Dividend yield is 0.8%. Directions QQQE includes the constituents of the NASDAQ 100 in an equal weight allocation. The fund is rebalanced quarterly to adjust for market fluctuations. The equal weight format is interesting for the tech-heavy NASDAQ 100, which includes the top 100 stocks on the NASDAQ exchange. There's a lot of growth potential in the second tier of NASDAQ 100 stocks, behind Apple, Microsoft, Amazon, Tesla, and Nvidia. QQQE gives you greater access to that potential and more balanced sector exposure. For context, the NASDAQ 100 in its modified cap-weighted form is 49% in technology. Directions QQQE fund has tech exposure of 36%. 5. iShares MSCI ACWIX US ETF. Expense ratio is 0.34%. Dividend yield is 2.5%. ACWX invests in large and mid-cap stocks across developed and emerging market countries. The fund does not include U.S. stocks. ACWX provides international growth exposure without overlapping any U.S. stocks you already own. For an international and emerging market fund, it has a reasonable expense ratio and dividend yield of 0.34% and 2.5%, respectively. The portfolio is broadly diversified across more than 1,800 stocks in 46 countries. Many of the stocks have names you will recognize, such as Taiwan Semiconductor, Nestlé, Samsung, and AstraZeneca. The largest sector exposure is 21% in financials. 6. iShares Core S&P Midcap ETF. Expense ratio is 0.05%. Dividend yield is 1.6%. IJH tracks the S&P Midcap 400 Index, which includes 400 companies that have market values between $5.2 billion and $14.5 billion. Index constituents must also be profitable and meet minimum trading volume requirements. iShares IJH fund provides low-cost exposure to high-quality mid-cap stocks. Mid-caps deliver a nice balance of risk and reward. They're generally more stable than smaller companies and have good growth potential. Many are on the trajectory to grow into large caps or become acquisition targets for large caps. Either outcome is a win for investors. 7. Pacer U.S. Cash Cows 100 ETF. The expense ratio is 0.49%. The dividend yield is 2.2%. COWZ invests in 100 Russell 1000 stocks that produce the highest free cash flow, FCF yield. FCF yield is the sum of FCF per share and stock price. FCF weights the stocks in the COWZ portfolio, but it caps it at 2%. Rebalancing happens quarterly. The fund strategy of investing in companies that produce excess cash creates a portfolio that's heavy on value. As of the most recent rebalance, COWZ assets cumulatively produced a 9% FCF yield and had a PE ratio of 9.1. The same metrics for the Russell 1000 are somewhat less compelling, 3.1% FCF yield and a 24.5 PE ratio. The drawback of this fund is its high expense ratio of 0.49%. High expense ratios limit the returns of underlying assets that flow through to investors. In COWZ case, the fund's 5-year returns of 12.3% are still competitive, despite high expenses. Number 8. iShares Morningstar Midcap Value, IMCV. Expense ratio, 0.06%. Dividend yield, 2.6%. IMCV invests in mid-cap stocks that seem undervalued by the market. The fund tracks the Morningstar Mid-Cap Broad Value Index, which is cap-weighted. IMCV provides cost-efficient exposure to more than 300 mid-cap value stocks. Investors frequently overlook the mid-cap value sector because they prefer the security of big companies or the excitement of small ones. That means there are deals to be had for the mid-cap investor who's in for the long term. To be clear, value stocks had a tough 2023. IMCV specifically is down 0.62% in the 12 months before November 2023. But historically, value stocks do outperform their growth-oriented counterparts over the long term. Number 9. Invesco FTSE RAFI U.S. 1500 Small Mid ETF. The expense ratio is 0.39%. The dividend yield 1.2%. PRFZ tracks the FTSE RAFI U.S. 1500 Small Mid Index. Index constituents are the 1,500 stocks behind the top 1,000 stocks, according to RAFI fundamentals. Those fundamentals include dividends, book value, sales, and cash flow. PRFZ delivers small and mid-cap exposure that's weighted by performance metrics rather than market value. This shields investors from overconcentration brought on by excessive investor enthusiasm. A quick stock price rise can easily result in overvaluation, which adds risk to your portfolio. Also, regular rebalancing of PRFZ trims higher-priced stocks and builds lower-priced ones. That follows a contrarian strategy of buying low and selling high. Number 10. iShares Core U.S. Aggregate Bond ETF. The expense ratio is 0.03%. The dividend yield is 4.3%. AGG invests in U.S. investment-grade bonds. The portfolio is mainly comprised of U.S. Treasury debt, mortgage-backed securities, and corporate debt from industrial, financial, and utility companies. Maturities are also diversified but weighted towards 7 to 10-year durations. A bond ETF like AGG provides stability and income. And now's a good time to add those qualities to your portfolio, since the bond market is broadly expected to be positive in 2024. AGG invests across the entire U.S. investment-grade debt market and maintains a low expense ratio of 0.03%. Since the portfolio is diversified across issuers, debt types, sectors, and maturities, it can fulfill your U.S. fixed income allocation requirement on its own. Investing strategies for long-term success. ETF investing is a time-efficient way to invest, but it isn't hands-free. You will need a plan in place to get the best results. The following 5 steps could act as a roadmap to support the long-term success of your ETF strategy. Number 1. Define a target asset allocation. Asset allocation is the composition of your portfolio across various asset types. This composition is a primary determinant of risk. Before you invest in ETFs, design an asset allocation that aligns with your risk tolerance and investment timeline. That allocation should then guide your ETF research and trade decisions. Number 2. Know your strategy. Put some thought into your investment philosophy so you can choose ETFs that match your mindset. As an example, do you prefer to hold stocks that outperform or take profits and reinvest elsewhere? The answer can tell you whether you're a better fit for a standard S&P 500 fund or an equal-weighted S&P 500 fund. 3. Review fund holdings. With ETFs, it's easy to get overweighted in certain stocks accidentally. Go beyond reviewing an ETF's investment strategy and dive into its specific holdings. Compare those holdings to other ETFs you already own or are considering. Taking that extra step will help you remain appropriately diversified. Number 4. Look past returns. Returns are important, but within the context of the market segment. A diversified portfolio should have assets that perform well when others perform poorly and vice versa. These offsetting behaviors keep your portfolio volatility in check. Number 5. Revisit your allocation. Your investing timeline and risk tolerance will change over time. Make a note in your calendar to revisit your target asset allocation annually, ideally before you rebalance. The usual practice is to shift towards a more conservative allocation as you near retirement. ETFs can provide a quick path to a diversified, wealth-generating portfolio that's easy to manage. Spend the time up front to research and choose funds that align with your investment philosophy and goals. Then revisit your ETF portfolio annually and adjust as needed. Stay on that program for the long haul, and you can look forward to wealth and prosperity in the years ahead. As a reminder, always conduct thorough due diligence before investing your hard-earned cash in stocks or the market. Don't forget to show your support by liking this video and subscribing to our channel for weekly updates on the best stocks to buy and cutting-edge investment strategies for building wealth. Thank you for watching, and may your investments thrive in the years ahead.